Welcome to Tesla Daily News Podcast. I'm your host, and today is February 17th, 2026. We're covering the Tesla stories that matter most for Tesla: demand signals, autonomy timelines, margin levers, and where regulation could force design changes. Story 1. Tesla just put a fresh incentive on the table for its biggest volume product. Context: when Tesla tweaks financing, it's often a real-time read on demand and inventory, and it can quickly impact both deliveries and gross margin. Details: a new financing promotion is highlighting approximately 0.99% APR for certain new Model Y premium trims in the United States, arriving alongside reports that Tesla's January sales were down about 17% year-over-year. Impact: lower APR is effectively a price cut that doesn't show up as an MSRP reduction. It can stabilize near-term deliveries and improve conversion, but it also pressures automotive gross margin unless Tesla offsets it with cost reductions or higher take rates on software and options. Investors should watch whether this becomes a short, targeted push or a broader incentive cycle. Takeaway: incentives are back in focus. If promotions expand across more trims or markets, expect analysts to rework margin assumptions for the next quarter. Story 2. Full self-driving in China is still in motion, but the schedule is not. Context: China is one of Tesla's most strategic markets for both volume and autonomy data, but it's also one of the most sensitive regulatory environments for advanced driver assistance. Details: Tesla China leadership says FSD localization work is underway, including a training center, and the company believes the system can perform at a level not below local human drivers once officially launched. The key detail, though, there is no confirmed launch timeline and approval hinges on regulators. Impact: for the stock, China FSD is a potential upside catalyst because it could open a high-margin software revenue stream in a massive installed base. But the lack of a date is the real headline for traders. It keeps that catalyst out in the future and pushes near-term valuation back toward hardware fundamentals like deliveries and margin. Takeaway: treat China FSD as an option with uncertain timing. The moment you see credible signs of regulatory clearance, sentiment could shift quickly. Story 3. Tesla is reportedly still working on Apple CarPlay, but it's delayed for two very Tesla reasons. Context: Tesla has historically resisted CarPlay to control the in-car software stack, data, and user experience. If Tesla adds it, it's a sign the company is responding to consumer expectations and competitive pressure. Details: reporting suggests Tesla's CarPlay work is being held back by compatibility issues between Apple Maps and Tesla's navigation stack that supports autopilot and FSD, plus concerns about the slower adoption rate of iOS 26. Impact: CarPlay won't move revenue like FSD, but it can matter for demand and customer satisfaction, especially in markets where CarPlay is table stakes. If Tesla implements CarPlay as an embedded app window rather than letting it take over the whole screen, Tesla keeps control of its core driving visualization and autonomy UI while still offering the feature buyers want. Takeaway: this is a demand defense story, not a margin expansion story. If Tesla ships CarPlay cleanly, it reduces one more reason shoppers cite for choosing a competitor. Story 4. Tesla is changing the rules on transferable perks, and that matters for pricing power. Context: Tesla has used features like full self-driving, free supercharging, and premium connectivity as tools to boost purchase intent and support higher-end trims. Transferability affects resale value, and resale value feeds back into new car demand. Details: reports indicate buyers of certain new Model S, Model X, or Cyber Beast configurations with a luxury package will not be able to transfer FSD, lifetime supercharging, or lifetime premium connectivity to a new owner upon resale. Impact: this can help Tesla protect long-term software monetization because it nudges the next buyer to pay again rather than inheriting features for free. The trade-off is potential softness in resale values for those configurations, which can reduce the perceived total value of buying new. Takeaway: watch whether Tesla expands this policy. It's a subtle but important lever that can increase software attach rates over time, even if it irritates some buyers. Story 5. Tesla is pushing deeper into solar manufacturing ambitions in the United States. Context: Tesla Energy has been a growth bright spot when storage ramps, and vertically integrated solar manufacturing could improve control over supply, cost, and scale, if executed well. Details: Tesla is reportedly evaluating sites including New York, Arizona, and Idaho to produce solar cells, with an ambition on the order of 100 gigawatts per year in the United States. Impact: if Tesla can manufacture at scale competitively, it strengthens the energy ecosystem narrative, solar generation feeding Powerwall at homes and Megapack at grid scale, all tied together with Tesla software. For the stock, the key is whether this becomes a real, margin-accretive business line or another capital-intensive project with long payback. Takeaway: this is a strategic optionality story. Investors should look for concrete capex plans, timelines, and whether Tesla can pair solar output with high-margin storage deployments. Story 6. The Tesla Semi looks like it's moving closer to broader commercialization, but pricing sets expectations. Context: Tesla's truck program is often treated as a long-dated call option. If it scales, it diversifies revenue beyond passenger EVs and can unlock fleet relationships. Details: reports say Tesla Semi is entering a more mass-market phase, with pricing starting around $290,000 for a version targeting roughly 805 kilometers of range. Impact: high sticker prices can still work in commercial trucking if total cost of ownership wins fuel, maintenance, uptime, and charging access. But for Tesla, the near-term question is production scale. Revenue impact depends less on the headline price and more on how many units Tesla can build and deliver consistently. Takeaway: Semi is becoming more real, but investors should stay focused on manufacturing cadence and gross margin profile, not just specs. Story 7. Regulation in China may force Tesla to rethink a signature interior design choice. Context: design changes sound cosmetic until they create retooling costs, complexity, or region-specific variants, all of which can pressure margins. Details: draft safety standards in China aim to ban yoke-style steering wheels starting January 1, 2027. Tesla has used yoke designs on some Model S and Model X variants. Impact: the financial impact is likely manageable, but the strategic message matters. China's regulators are increasingly willing to standardize cabin controls and safety-related design. If similar rules expand to other interface elements, it could push Tesla toward more conservative hardware in some markets. Takeaway: keep an eye on regulatory drafts becoming final rules. Compliance changes are usually small individually, but they add up as complexity, and complexity is the enemy of automotive margin. Let's wrap it up. Today's big themes were demand management through low APR financing, autonomy upside with uncertain timing in China, and a mix of product and policy decisions that influence margins and customer value, from CarPlay delays to non-transferable perks. For tomorrow, watch for any new data on deliveries and pricing, and especially any concrete signal on China FSD approvals, because that's the kind of headline that can move Tesla fast. If you found this helpful, subscribe to Tesla Daily News Podcast and follow for your daily, investor-focused Tesla update.